Hi there. In this video, we'll discuss final tax returns, overlap profits, and important HMRC reporting requirements when ceasing self-employment.
Picture this. You've been working hard as a sole trader for years, maybe as a freelance graphic designer, a marketing consultant, or a local tradesperson. You're making a solid living, somewhere between 30 and 60 grand a year. You finally decide it's time to close up shop, maybe to retire, or perhaps to take a great full-time PAE job. You send a quick email, shut the doors, and think you're totally done, right? Well, no. Welcome to this explainer brought to you by My Tax Accountant. Today, we are focusing squarely on a highly specific but incredibly dangerous scenario, stopping self-employment. We're going to dive deep into your final tax return and overlap profits here in the UK for the 2026-27 tax year. The tax rules have completely shifted recently, and getting this final step wrong could honestly cost you a fortune.
So, did you know that simply stopping your trade without proper planning could trigger a massive, completely unexpected tax bill? It's a shocking reality that is catching out so many hard-working UK entrepreneurs right now. Imagine a freelancer who decides to stop working, completely ignores the upcoming 5th of April 2026 deadline, and as a direct result, permanently loses thousands of pounds in tax relief that rightfully belongs to them. But wait, it gets worse. Because of recent rule changes, they accidentally accelerate all their remaining transition profits into a single year. Suddenly their income spikes well over that £50,270 threshold, pushing them straight into the 40% higher tax bracket. Out of nowhere, they owe HMRC a small fortune. It's a complete nightmare, but it is entirely avoidable. And that is exactly why understanding this process matters so much.
Okay, here is our quick roadmap for today's explainer. We're going to cover 1. The cost of closing down. 2. Filing the final tax return. 3. The overlap relief deadline. 4. Transition profits and losses. 5. Capital allowances and records. And finally, 6. A summary and next steps. Let's get into it. Right, Section 1. The cost of closing down, and why it is really not as simple as just shutting your doors. You see, from HMRC's perspective, ceasing trade isn't just flipping a sign in your window from open to closed and walking away whistling. It actually draws a hard line in the sand, triggering a whole cascade of strict, unavoidable tax events. HMRC will immediately look to settle all outstanding balances, finalize your tax reliefs, and assess any remaining business asset values up to that exact closing date. And this is exactly why you need premier UK professionals like the team at My Tax Accountant to guide you through it. Listen, the entire UK tax system has just undergone the historic basis period reform, which effectively shifted everyone over to a standard tax year basis. Navigating a business closure right at the tail end of this massive transition requires expert compliance, so you don't accidentally step on any of the hidden financial landmines we're about to uncover today.
Moving on to Section 2, filing the final tax return, or basically telling HMRC it's officially over.
It would be brilliant if the paperwork just vanished the minute you stopped working, wouldn't it? Unfortunately, there are 3 mandatory steps to formally close the loop here. First, you must officially notify HMRC via your government gateway account of your exact cessation date, and that's the literal day you stopped trading with the intent to make a profit. Second, you've got to calculate your final trading profits up to that exact date, properly apportioning your income and your expenses. And third, you still have to file a final self-assessment tax return before the 31st of January deadline following the end of that tax year. Seriously, even if you earned absolutely zero in your final few months, if you don't officially deregister and file that return, HMRC just assumes you are still trading. They'll start slapping you with automatic £100 late filing penalties, which, trust me, quickly escalate into daily penalties and some severely heavy fines.
Okay, Section 3, the overlap relief deadline. This is the ticking clock on your money.
Now this bit is absolutely crucial because we are talking about real money that belongs to you. To explain this simply, overlap relief is a tax deduction for profits that you were essentially taxed on twice during the early years of your trade. Think back to when you first set up your sole trader business. If your accounting year-end didn't perfectly align with the standard tax year, say you always drew up your accounts to the 31st of December, HMRC's old rules meant some of those early profits were taxed twice. This created what's known as overlap profits. Fast forward to today, and because of the recent basis period reform, everyone was forced to align their dates to the standard UK tax year of the 5th of April. If you didn't utilize this relief during the recent transition year, ceasing your trade is your absolute final opportunity to claim it. It is literally a deduction you can use to significantly lower your final tax bill. Don't leave it behind.
Let's map out the timeline we are working against here. The transition basis began in the 23-24 tax year.
If you forgot to claim your overlap relief then, well, you've got until the 31st of January 2026 to amend that specific return. But more importantly, if you are actively closing down your business right now, you must claim it before the window completely shuts. As this illustrates, we are rapidly approaching a hard stop where any unclaimed relief is going to vanish forever.
If you take absolutely nothing else away from today, remember this exact date, the 5th of April 2026. This is the absolute final deadline for sole traders to claim and utilize any remaining overlap relief before it expires and is permanently lost. If you stop self-employment and you fail to put this figure on your final tax return, HMRC is not going to tap you on the shoulder and automatically do it for you. There's no friendly reminder letter in the post. You are simply leaving your own hard-earned money on the table for the government to keep. No way do you want to do that.
Right. Section 4, transition profits and losses. And guys, this is the acceleration trap.
This brings us to probably the most dangerous part for our typical sole trader earning between 30 and 60 grand, the terrifying acceleration trap. Let's do the maths on this slowly. When the basis period reform happened, many businesses had extra transition profits generated by aligning their dates. Normally, HMRC kindly allows you to spread these transition profits evenly over 5 years, ending in the 2027/28 tax year. That's just 20% a year, which keeps your tax bill nice and manageable. But here is the massive catch. If you cease trading before 2028, that friendly spreading mechanism instantly terminates. All those remaining untaxed transition profits, they accelerate and pile straight into your final year like an avalanche. Let's say you earn £45,000 a year from your trade. You're sitting comfortably in the 20% basic rate. Suddenly, your business closes and £20,000 of transition profits are dumped right into your lap. Your income shoots up to £65,000. Bam! You are instantly pushed well over the threshold into the 40% higher rate tax bracket. You'll literally be paying double the tax rate on a large chunk of that money. Planning your exact cessation date is absolutely vital to dodge this bullet.
But it's not all doom and gloom. Here's a massive professional tip for you. What if deducting your overlap relief actually creates a loss in your final year? Well, you can use what's called terminal loss relief. This is an incredibly powerful rule that allows you to carry back losses from your final 12 months of trading up to 3 years against your previous profits. Let's say your final year ends in a £5,000 loss, but you paid plenty of tax 2 years ago. Terminal loss relief is essentially a legal mechanism to claw back that income tax you've already paid to HMRC in the past. HMRC will literally issue you a refund check. It is a bit complex to calculate for sure, but highly rewarding if you do it correctly with a qualified accountant.
Which brings us to Section 5, Capital Allowances and Records, sorting out your assets and your paper trails.
So, we're now looking at the physical assets of your business. Just because you've stopped trading doesn't mean your work vans or your laptops suddenly become invisible to the taxman. In your final year, you cannot claim standard capital allowances, like the annual investment allowance. Instead, you have to do a final tally. Let's say you decide to keep a business laptop for personal use. If its current market value is more than its remaining value on your tax return, you get hit with a balancing charge. That means HMRC claws back tax relief, which adds to your final taxable profits. On the flip side, if you sell a work van to a dealership for less than its tax value, you get a balancing allowance. This gives you extra tax relief, which reduces your final tax bill.
And then there's the paperwork. The paper trail doesn't just end on your cessation date. Even after you officially close, HMRC legally requires you to hold on to specific business records securely. Whether they are physical paper trails neatly filed in boxes in your attic or digital cloud backups of your accounting software, you need to keep them safe. This includes your sales documents and invoices, your bank statements, purchase receipts, your business expenses logs, and of course all your VAT information if you are a registered business. So how long do you have to keep all of this? 5 years. But wait, there is a catch here. It's not just 5 years from the day you closed your doors. It is a full 5 years after the 31st of January deadline of the relevant tax year of your cessation. If HMRC decides to open a compliance check into your closed business years down the line, and you've thrown your receipts in the bin or deleted your spreadsheets, well, you will face severe, escalating financial penalties simply for failing to keep your records. Don't risk it.
Finally, Section 6, Summary, Disclaimer, and Next Steps. How to protect your transition safely.
Closing down a business is a massive life event, and we want to ensure you execute this transition safely. Let's do a really quick recap of the essential steps. First, Pick a formal cessation date and notify HMRC so you stop the penalty clock. Second, and most urgently, claim every single penny of your overlap relief before that 5th of April 2026 deadline. Third, brace yourself for the acceleration of your transition profits and plan carefully for a potential tax bracket jump from the basic rate to the higher rate. Fourth, properly calculate your final capital allowances and see if you qualify for a terminal loss refund. And finally, pack up your records and keep them safe for 5 years.
Now, a quick but important note. This explainer is strictly for educational and informational purposes, specifically applying to the 2026/27 UK tax rules. Tax law is highly individual, right? What works perfectly for a freelance graphic designer might not be the exact right path for a self-employed plumber with heavy machinery assets. You should always seek professional advice tailored specifically to your unique situation before taking any direct action.
And honestly, that is exactly where we come in. Don't try to navigate this tax minefield completely on your own. Reach out to My Tax Accountant today. You can call us right now on 0208-570-8531. Drop us an email at info@mytaxaccountant.co.uk or just visit our website at www.mytaxaccountant.co.uk. Our experts are ready and waiting to help you close down safely. Oh, and also make sure to subscribe to the MTA YouTube channel for more expert guidance and regular UK tax updates.
So, I'm going to leave you with this one final provocative thought. When you finally turn that key in the door for the very last time, are you absolutely certain you've claimed every single penny you're legally owed before closing your business forever? Seriously, don't let HMRC keep your overlap relief. Take control, get the right advice, and protect your hard-earned money. Thank you so much for joining me on this explainer, and we will see you next time.